The Great Depression. It wasn't just a bad time, it was an economic disaster that changed everything. In 1929, the American economy crashed after years of reckless speculation and widening inequality. 1 in 4 workers lost their jobs. 9,000 banks failed, wiping out life savings. The warning signs were there, but greed and denial drowned them out. The government's response? Trade barriers and higher interest rates, moves that only made things worse. What started as a national crisis quickly became a global catastrophe. The Great Depression wasn't a natural disaster, it was the result of bad decisions and ignored warnings. It's a stark reminder of what happens when hubris and reckless financial behavior go unchecked. The real question, could it happen again? Take a moment to look around. Really observe the world we're living in. Doesn't today feel eerily similar to the Roaring Twenties? The energy, the optimism, the relentless pursuit of progress, it's all there. We see the echoes of a bygone era reverberating in our modern society. The parallels are striking, almost unsettling. It's as if the past is repeating itself, just with a digital twist. More screens, more connectivity, more information at our fingertips than ever before. But beneath the surface of technological advancement, are we making the same fundamental mistakes? Back then, new tech like the automobile and radio, coupled with easy credit, fueled a widespread sense of euphoria, a belief that the good times would never end, that prosperity was limitless. It was an era of unprecedented growth and innovation, but also of unchecked speculation and excess. Today, we see a similar phenomenon with AI stocks soaring to unprecedented heights, driven by hype and speculation. Crypto bubbles inflate and burst, and buy now, pay later apps encourage impulsive spending, masking underlying financial vulnerabilities. It's a new form of financial exuberance. But is it built on a solid foundation? The speculative mania is back with a vengeance, just repackaged in a sleek digital form. The tools have changed, but the underlying human behavior remains the same. Extreme inequality? Check. The gap between the rich and the poor is widening at an alarming rate, mirroring the disparities of the Roaring Twenties. The top earners rake in a massive share of the wealth, accumulating fortunes at an astonishing pace. Meanwhile, millions struggle to make ends meet, working multiple jobs just to stay afloat. Debt is ballooning to unsustainable levels, burdening individuals and families with crippling financial obligations. And the middle class, the backbone of our society, is shrinking, facing unprecedented economic pressures. Politicians bicker and engage in partisan warfare while the fundamental issues facing our nation go largely unaddressed, exacerbating the underlying problems. We're seemingly ignoring the same warning signs that preceded the Great Depression a century ago. The headlines celebrate record market highs and booming corporate profits, but for the vast majority of people, life is becoming increasingly difficult, with rising costs of living and stagnant wages. The system may appear strong and resilient on the surface, but beneath the facade it's incredibly fragile, riddled with hidden weaknesses and vulnerabilities. The question isn't whether these parallels between the Roaring Twenties and today exist, they are undeniable. The crucial question is whether we, as a society, have learned enough from the mistakes of the past to avoid repeating the same catastrophic ending. Are we destined to repeat history, trapped in a cyclical pattern of boom and bust? Or are we finally ready to learn from our past mistakes and change the story, forging a more sustainable and equitable future for all? America is drowning in debt. It's a silent crisis, creeping beneath the surface of our everyday lives. Like a rising tide, it threatens to engulf individuals, businesses, and even the government itself. We see the headlines, we hear the warnings, but do we truly grasp the magnitude of the problem? Households, corporations, and the government alike. No sector of our economy is immune. From Main Street to Wall Street, debt has become an inescapable reality, a burden that weighs heavily on our collective future. Household debt has soared past $18 trillion. This staggering number represents more than just mortgages. It includes auto loans, student loans, and the ever-present credit card balances that many families struggle to manage. Credit card debt alone is at a record $1.2 trillion. It's a testament to the increasing reliance on credit to make ends meet, a dangerous trend that can quickly spiral out of control. People aren't borrowing for luxuries, they're borrowing to survive. The rising cost of living, stagnant wages, and unexpected expenses force many to rely on credit just to cover basic necessities like food, housing, and healthcare. Corporations are loaded with debt, often using it for stock buybacks instead of real investment. This short-sighted strategy inflates stock prices in the short term but weakens the long-term health of the company and the overall economy. The U.S. government's debt? Over $34 trillion with interest payments nearing $1 trillion a year. This is money that could be used for infrastructure, education, or other vital public services, but instead, it's being used to service the ever-growing debt. We're using new debt to pay off old debt, a recipe for disaster. It's a Ponzi scheme on a grand scale, and it cannot continue indefinitely. This mountain of borrowing makes the entire system fragile. One unexpected shock, one economic downturn, could send the whole thing tumbling down. In the 1920s, debt fueled the boom and the crash. Excessive speculation and easy credit led to unsustainable growth, followed by a devastating collapse. Today, the scale is even bigger. The stakes are higher, and the potential consequences are even more dire. Delinquencies are rising, banks are stressed, and the risk of collapse grows. The interconnectedness of the global financial system means that a crisis in one country can quickly spread to others, creating a domino effect with potentially catastrophic results. The higher the debt, the harder the fall. The more we borrow, the more vulnerable we become to economic shocks and unforeseen events. The system only works as long as everyone can keep paying. As long as wages keep pace with inflation, and as long as interest rates remain low, the house of cards can stand. But cracks are showing. Inflation is stubbornly high, interest rates are rising, and the global economy is facing numerous challenges. The time bomb is ticking. We must address this debt crisis before it's too late. The future of our economy, and the well-being of generations to come, depends on it. For most people, the economy is about what's left in their bank account. Wages have barely grown in 40 years, while the cost of living has exploded. Essentials like education and housing are outpacing paychecks. Student debt alone is nearly $1.8 trillion, trapping a generation in financial quicksand. To keep up, people turn to credit cards and loans, not for luxuries, but to survive. It's a dangerous cycle. Debt props up spending, masking the real problem of stagnant wages. More and more people are falling behind, living paycheck to paycheck. This isn't sustainable. It's a pressure cooker. When the credit runs out, the system cracks. The wage squeeze is a social and economic time bomb. Wall Street's risky behavior isn't new, it's history repeating. In the 1920s, wild speculation and leverage set the stage for disaster. Today, it's complex financial products, crypto, and a focus on short-term profits. Stock buybacks enrich executives but weaken companies. Most Americans are now tied to the market through retirement funds. A crash would hit everyone. Regional banks are under pressure, with commercial real estate loans coming due and higher rates making refinancing impossible. Bank failures are warning signs, not isolated events. The system is vulnerable, just like before the Great Depression. We're seeing echoes of the past in every corner of finance. The risks are bigger and the stakes are higher. After the Great Depression, we built safety nets. Unemployment benefits, deposit insurance, central bank interventions. These tools have helped us avoid another depression, so far. But every rescue piles on more debt, treating symptoms, not causes. Our safety nets were built for a simpler, less connected world. Today, crises spread globally in seconds, not months. The financial system is so complex that a failure in one area can trigger a global domino effect. Bailouts create moral hazard, encouraging even riskier behavior. We're more indebted and fragile than ever. Our safety nets may not be enough for the next crisis. We've built a better fire alarm, but the house is soaked in gasoline. The global economy, a vast and intricate network, is more connected than ever before. Supply chains crisscross continents, financial transactions happen in milliseconds, and information flows freely across borders. This interconnectedness has brought unprecedented prosperity and innovation to many parts of the world. But this very interconnectedness also makes the system more fragile than ever. The intricate web of dependencies means that a disruption in one area can quickly cascade throughout the entire system, leading to unforeseen consequences. Supply chains and financial markets span the globe, linking producers, consumers, and investors in a complex dance of interdependence. Raw materials are sourced from one country, manufactured in another, and sold in yet another, all orchestrated by intricate logistical networks. This globalization of finance and trade, while efficient, also means that economic shocks travel instantly. A financial crisis in one country can quickly spread to others, disrupting trade flows and investment patterns. In the pursuit of maximizing profits, Efficiency has replaced resilience in many sectors of the economy. Just-in-time manufacturing, lean operations, and minimal inventory levels have become the norm, all in the name of cost savings. But this relentless focus on efficiency has come at a cost, leaving us exposed to disruptions and vulnerabilities. When supply chains break down or demand surges unexpectedly, the system struggles to cope, leading to shortages and price spikes. Governments around the world are already deep in debt, burdened by years of deficit spending and accumulating liabilities. This leaves them with little room to maneuver when faced with economic downturns or unexpected crises. The ability to stimulate the economy through fiscal policy is severely constrained. Central banks, the traditional firefighters of the financial system, have already used up their main tools, such as lowering interest rates and quantitative easing. With interest rates already near zero and balance sheets bloated with assets, there's little left in the arsenal to combat the next emergency. The traditional policy responses may prove ineffective. If a crisis hits now, whether it's a financial meltdown, a pandemic, or a geopolitical shock, another massive rescue on the scale of the 2008 bailout may simply not be possible given the already strained state of government finances. The financial system has become so complex and leveraged with layers upon layers of opaque financial instruments that it's vulnerable to a hard reset, a sudden and disruptive collapse, rather than a gentle correction. The interconnectedness of the system means that a failure in one area can quickly spread to others, triggering a cascade of defaults and bankruptcies. Savings accumulated over a lifetime of hard work could vanish in a market crash or a bank failure. Demand, the lifeblood of the economy, could collapse as consumers lose confidence and cut back on spending. And businesses, already struggling with debt and declining sales, could fail en masse, leading to widespread job losses and economic hardship. Most dangerously, people could lose faith in the system itself, leading to social unrest and political instability. The social contract, the implicit agreement between citizens and their governments, could be broken. The cracks in the system are spreading, widening with each passing crisis, threatening the entire structure of the global economy and the social order that rests upon it. We're not entering the next crisis from a position of strength, but rather from a position of vulnerability and weakness. The foundation upon which our prosperity is built is already shaking, and the tremors are growing stronger. In a crisis, we look to leaders for action and vision. During the Great Depression, FDR's New Deal was bold, imperfect, but decisive. Today, we see gridlock and spectacle. Congress struggles to pass even basic laws. Leaders argue over distractions while real problems fester. The Federal Reserve is stuck. Raise rates and risk recession, lower them and risk inflation. Their tools are blunt, and the stakes are enormous. Ordinary people feel the pain while leaders debate theories. The disconnect between the powerful and the public is growing. Without real leadership, economic crisis can become a crisis of democracy. Who's really flying this plane? History doesn't repeat, but it rhymes, and the echoes are getting louder. The same ingredients are back: inequality, debt, and reckless speculation. We keep hearing, this time is different. But is it? The Great Depression was avoidable. Bad choices made it inevitable. We face similar choices now. Ignore the cracks or fix the foundation. Real solutions mean tackling inequality, reining in financial excess, and investing in the future. It takes leadership willing to act, not just talk. The future isn't written. A new depression isn't certain, but it's possible. We have the lessons and the answers. The test is now. Will we pass, or are we about to fail in spectacular fashion?